Alright, so price has mitigated your higher time frame POI, and you want to execute the trade using a lower time frame so that you can secure a higher risk to reward compared to just taking a direct entry based on the same time frame. So in that case, how do you go about it? Alright, I will start with a simple diagrammatic explanation so as when we shift into a real chart, it becomes easier to catch up. And without further ado, then let me dive in. So starting with the multi-time frame selection, if you're using the H4, I mean the 4-hour time frame as the one that you're marking the key areas and the liquidity levels, this means now your lower time frame will be the M15, or you will be using the lower time frame as M15. And if you're using the H1, that is the 1-hour time frame, then you will be using the M5 as your lower time frame as well as your entry time frame. If you're using the M15, you then be using the 3-minute time frame as your lower time frame or your entry time frame. And then finally for the scalpers, if you're using the M5 as your higher time frame, then the M1 will be your entry time frame. So this here is the multi-time frame selection, and it's very important to have this. And another thing that I need to note is that if you decide to choose here like a selection that you'll be using, if you decide to pick the H4 and the M15 as your time frame selection, then you will need to stick with that. By this I mean, not today you're using the H4 and the M15, then tomorrow you shift to H1 and M5, or maybe after a week you're already on the M15 and the M3. Like if you decide to choose a time frame selection, stick with that like for a very long period of time and see if it works for you before you decide to shift into another time frame selection. All right, so that's all about the time frame selection. Now diving into our diagram right here, we can clearly see now this here is the higher time frame point of interest. And by a point of interest, in our case as true SMC traders, we know it's either an order flow or an order block. And also you can clearly see this dotted line. I have represented this as a liquidity level, and we all know our liquidity level, that is the inducement and the engineering liquidity. So right here, so you can see POIs that we use, it's actually the extreme POI and the decisional POI. By a POI, I mean either an order flow or an order block, and the same here. And for the liquidity level, I mean either the inducement and the engineering liquidity, because these are the core liquidities that we actually consider in true SMC. Alright, so back here, you can see I have used this color to represent the higher time frame and the blue color to represent the lower time frame, even on the diagram. Alright, so immediately after price has mitigated the point of interest or swept the liquidity level, we immediately shift to the lower time frame. And I have just showcased the time frames exactly right here. So in this case, you can see I'm using the blue color showcasing the lower time frame. So upon shifting to the lower time frame, you will need to mark the structure so that you identify the major inducement. And in this case, I'm specifically saying the major inducement. So this means now you will need to mark the market structure. Alright, we all know how to mark the market structure. And by the way, the market structure mapping is the same in every time frame. Alright, so upon shifting into your lower time frame, you need to mark the recently formed trading range so that you identify your inducement, and in this case a major inducement. So upon price sweeping the major inducement, it confirmed this one here as a swing point, and you can clearly see price reversed after that and broke past the swing point, confirming a break of structure into our lower time frame. Then after that, after the break of structure, that is, price created another valid pullback right there. You can clearly see upon mitigation, this one here is the recently formed valid pullback on our lower time frame. And we always know that the inducement is the recently formed valid pullback. I mean, not the pullback, but the liquidity resting below that recently formed valid pullback low. That's what we call the inducement. In this case, it's a low because we are in an uptrend. And this inducement, you can clearly see here, instead of me marking it as a major inducement, I marked it as a change of character. This means now, upon price mitigating a higher time frame point of interest or sweeping a liquidity level, I mean a higher time frame liquidity level, then the lower time frame major inducement changes its role from being an inducement to being a change of character. like in this case. And that's the reason as to why I didn't mark it as a major inducement. Instead, I marked it as a change of character because it has changed its role, and it has changed its role after the higher time frame POI mitigation, or after sweeping the higher time frame liquidity level, the major inducement. And in this case, I'm actually specifying the major inducement. This means if it's a minor inducement, then this means we are not considering the minor inducement in this case. So now let me change the scenario so that we can include the minor inducement. So like let's see, now the break of structure is somewhere there, so this means the high is right there. So you can clearly see now this one here is no more a, this one is no more a major inducement, but now it's a minor inducement. So this means now this is no more our change of character, because we said we need the major inducement, and since now the major inducement will be our trading range low, then this one here will be now the change of character. So in this case, you will need to wait until the major inducement, I mean price, takes out, I mean breaks past the major inducement. Now that's when, and by the way, by a break I mean break by a candle close past the major inducement, which now, upon mitigating a higher time frame point of interest, the lower time frame major inducement changes its role from being an inducement to being a change of character. And you can clearly see, since this one here is the minor inducement, and we said we consider the major inducement, and in this case there is no major inducement in our trading range except the trading range low, and so the trading range low becomes now the change of character right now. So after price has broke past the major inducement, confirming our change of character, we'll be now in a new trading range in that lower time frame. So this means our trading range will now be ranging from this high that mitigated the higher time frame point of interest to currently where it will be. And in this case now we'll be doing the same. That is, after identifying the trading range, we obviously need to make sure that price has taken out the inducement. So after price has taken out the inducement, now the process becomes similar. Alright, so after price has taken out your major inducement, now mark your POIs. And as we all know, the order flows are primary and the order blocks are secondary. In our case right here, I can see this order flow, and you can see price mitigated the order flow and gave that reaction. In this case, if price gives this kind of reaction, making a break of structure, this means our higher time frame point of interest is respected. And by the way, here is a super tip. After price has taken out the major inducement, and in this case is not a sweep but a break past it, I usually recommend to place a limit order exactly at the POI, and your stop loss needs to be above the trading range high or at the trading range high. And obviously the TP, it's actually depending with you if you want a fixed risk to reward or just extending it towards the higher time frame external liquidity. It's upon your decision, but that's a super tip. I usually recommend this rather than just waiting for a reaction from the POI and placing your stop loss above that reaction. I usually find that this way of just placing the sell limit order is less stressful and more profitable. Alright, so that, let's say now you missed the entry, price has created a break of structure. Obviously now here you'll just be trading normally as per using the same time frame, I mean based on the same time frame. You just need to, after price has made that break of structure, mark your inducement. I usually like the major inducement, but also minor inducements do work. I've actually showcased this on the previous part before this. So after price has taken out the inducement, in this case it was a sweep. You can clearly see here, in this case it was a sweep, so you can take the sell. And obviously for me, if I see something like that, it's a sweep, even though I know I need to place my stop loss right there, I usually place my stop loss above the trading range high. Like, I usually like this because you're actually trading based on the same time frame. Why risk like being stopped out, and you can actually place the stop loss above here or at that high, secure it, and just get a good risk to reward. Also, there is no need to get a 1:20, and you can still get a 1:8 without getting stopped out. All right, so that's something to consider. And also, if you missed that entry, you can still take another entry, like after price has created another break of structure. So after price has created another break of structure, you can still take the entry right there after price has taken out the inducement. All right, or maybe mitigated a higher time, or maybe mitigated the POI. In that case, it can be an order flow, order block. the rules still apply. We said that it's actually working on each and every time frame. So after that, then price creating a break of structure, the major inducement being taken out, price mitigating a POI, you can actually sell, and the target profit is actually upon you. You can actually target the BOS, you can have a fixed risk to reward, or you can just target the ultimate higher time frame external liquidity. So you can see that the process of selling continues until the higher time frame external liquidity is taken out. So after price has taken out the higher time frame external liquidity, or after price has made that break of structure on the higher time frame, then you will ignore all what you have marked here, like all the inside structure, and now you will be shifting back into your higher time frame. That is after price has made it out to the external liquidity. Right guys, I don't want to make this video long, and I believe if you have made it out to this end, then you have really enjoyed the video and you have also learned a lot. On the next part, I will be showcasing everything that I have discussed here using simple diagrammatic representation like this one into a real chart, like a real chart, so that you can solidify all this knowledge. And also, even after that, I will still be dropping top-down analysis examples so that we can solidify the content. So drop a like and see you in the next part.